Hey, welcome back, everybody. And guess what? We have us a fabulous chart, fabulous show. And remember, let us know that you like the show by liking it and making sure you subscribe. Let's talk a little bit about these charts right here. So the title says, I love this title. It cracks me up. Buyers are eyeing everything, including the ugly homes. Well, something like that, because we have such low inventory. All right. Why would I say that? Let's dive into things. In fact, let's just hit it hard right off the bat. So let's hit our 7-day running average real fast.
Okay, when we take a deeper dive into our average 7-day running average, I guess that's redundant, but anyway, nonetheless, awesome number here. Again, seasonally normal. It's March. We're starting to kick into really kind of a hardcore spring market. We have 1,057 that came on market. However, still didn't surpass the number of pended homes at 1,122. 952 homes sold. All right. These numbers are still showing that buyers are still very active, and yeah, they're starting to take a look at some of those ugly ducklings out there.
All right. Now, if we take that, and because again, we've just seen so many pendants, even though again, like the chart showed, we had a ton of homes coming on market. Now let's take a look at, okay, what do we mean by that? So we're going to go back, let's go back 15 years. So let's blow this chart up.
So when we dial into this chart, you can see that the green line actually has what is available on market, okay? And as you can see, as we've taken this chart back to 2015, however, when we dial this even closer, 2017 was an amazing market. 2018 reaped the benefit of that as it drew down inventory quite a bit. 2019, that became a more of a recovery market. And then, of course, we have the crazy years of 2020, 21, 22. And then as we even see here in January of 2024, our inventory, as we show, is still super, super low. And that's why you're seeing a ton of ugly duckling houses out there going off market just out of the blues, sometimes with multiple offers, because there just are no other options at this point. So buyers absolutely being aggressive, well-priced homes, absolutely seeing multiple offers.
Okay, hopefully that makes a little bit of sense as to why we're talking about that buyers truly are now looking at some of the, we call the ugly ducklings out in the market, because as we are looking at our inventory dwindling down, even though this running day average, really because of yesterday, we saw a massive influx of homes. And in fact, many of our clients were getting a little disappointed because there was just nothing coming on. And then all of a sudden, boom, we had 400 and some odd come on market right away in the core areas that we're looking at. All right. So when we take a look and we kind of move on to what is having, again, the biggest impact, understand. So as we go through this, the feds do not control long-term mortgage rates. They control your home equity line of credit, which is also called the HELOC, your credit cards, what banks lend to each other on a day-to-day basis. They'll your car loans and whatnot. That is what they address, and including commercial lending, which is one of the, what we talk about, potential real estate bank failure concerns this year, is based on commercial real estate, not on residential. How it impacts residential will be their ability to be able to make loans, because as they have more commercial debt that goes into default, that reduces their ability to lend on dollars. All right, moving on. Let's take a look at Freddie here. So Freddie, as you can see, we've got a average of their 7-day of 6.94. It's a little bit higher than what we closed out on Thursday and Friday. Now, as we head over to this next chart, super interesting. Actually, it's not a chart necessarily, but it's a what we call our top titles. Okay, so the first one, I guess I'm going to blow that back up. Everybody says it's easier to read. There we go. Top titles for this week. We had the lowest mortgage rates this week after key inflation data. Thursday, Friday, that actually came down. We have a paradox. I know. Home prices face both headwinds and rising tides. Now, that is a super simple story. What they're talking about is the fact that mortgage interest rates each week for the last 4 weeks has been ticking up and ticking up and ticking up. Almost sounds like chitty chitty bang bang, but different. I guess I'm dating myself there. Anyway, my wife won't like that if I'm dating myself. Nonetheless, we have interest rates that are going up, but we have inventory that is continuing to fall. And so it's kind of like we're heading back into that 2020 perfect storm, except for in 2020, the rates went down into the threes and the twos, threes. And of course, that really drew down inventory. We're not going to see that, and nor are we going to see interest rates heading back into the threes. However, as we look at that, that is what that title is about, in that, their affordability is becoming almost untenable for new home buyers. In fact, Zillow put out what, in my humble opinion, is a super stupid comment that you need to, in the Seattle area, you have to make $200,000 to live comfortably. Oh, what a moronic statement. I'm so sorry. There's a lot of different salary ranges and home price ranges that people can live comfortably. Now, granted, if you want to live in the core areas and live in, a McMansion or something like that, sure, you have to make more, you have to do more. But there's both sides to everything. I get off my soapbox. Anyway, let's head back into the titles here. All right. Let's see here. New homes still in line with 2017, 2019 range. We're going to go over that in just a little bit. Rates continue to stall application volume. Yeah, no kidding. Rates go up. Buyers tend to slow down. That's totally normal. Is there a pent-up buyer demand? We just proved that, okay? But new applications are starting to wane a little bit. Not an unexpected thing. All right, let's head into some greater details. Let me blow this up. This is super important. Hang on.
So remember, we talk about the 10-year Treasury being a great benchmark as far as looking at how mortgage rates and the 10-year Treasury mirror each other. So as we saw on Thursday and Friday, we saw the numbers actually come down. Now, surprisingly enough, that actually came out because of Thursday's inflation data, and because they expected it not to be, kind of as expected, nothing earth-shattering, no great shifts in any way. That actually said to the market, hey, you know what? Rates we're going to come down because, numbers are as expected. There's nothing crazy. And that really benefited a lot of buyers out there.
Okay. Now, let's take a look at the stats from the Northwest MLS as, again, residential only. I don't look at condos, multifamily, vacant land, things like that. That doesn't matter. We use this report for residential only. So if you see a discrepancy on some of the numbers, that's the why. The bulk of people are buying residential homes. And if you want the condo report, reach out to us. We'll send it to you. It's a similar video, a little bit shorter. Again, it just dials in for both buyers and sellers. And, they find it valuable, just like to do with single family homes. All right, moving on. So when we toss this over, I forgot. Here we go. Guys, pay attention, especially today. Make sure that you're taking a look at this free tool that allows you to take a look at mortgage loan rates in a comparison, 4 of them side by side. More importantly, without a doubt, listen to the 18-minute video on 5 questions you need to ask about getting quoted mortgage rates. Super important. Why? Because the marketing for mortgages has gone crazy. And in fact, there are some folks advertising 6.25% rates that it's unreal, right? Really, at the end of the day, the principal balance that is allowed to be financed, a maximum, the minimum purchase, value of the home says you got to almost put 40% down. You have to have a credit score over 780. And, the reality is why would anybody go for that? Well, it's a teaser rate. It gets you to call. Pay attention to that video. It's free. pay attention to it. Watch it. Let me know what you think. All right, moving on. Let's get on to what I wanted to show you, which is this. All right, so you can see that we have an arrow in the upward trend, like what we went through at the beginning of the chart. But now let's compare that to homes that are on market, homes that are off. In fact, let's just blow this up. Hang on a second here.
So as we dial in, we take a look at the, basically this is the home pricing of active homes for sale. And we are seeing the normal seasonal uptick as you see it here. And this is the average sold price right here. And again, the normal uptick, a little bit steeper on the sold side than what we saw last year. And in fact, when we take a look at it, when we take a look at the same month since February is over, 22 or 23 over 24, we can see that we had a 4% increase in price. Then down here on the sold prices, we actually went up 8%. That's pretty impressive, all things considered. And then when we take a look at the fact that, we went from 736,000 to 801,000 for a sold price, that's showing that, hey, we're starting to see that spring market. We're, pushing off some of the higher mortgage rates and people seeing the values and starting to realize that, hey, the doom and gloom over the last 5, 7, 10 years that are saying the sky is going to fall. We've continued to say, no, that's not the case. We just don't have enough inventory. Well, so far it's holding true. And I guess if they wanted to, they could keep saying it. And in time, they will be right in time. But anyway, at this point, we are situation normal and actually heading in a very positive direction yet again this year.
All right. We had a couple of technical difficulties there. I'm pretty sure it's operator error. Nonetheless, let's continue on. So as we can tell, just as a quick recap there, right? Sales prices are going up, and so are, on the average, what the homes are listed for are going up. Seasonally normal. Okay. Just to reiterate that message again, seasonally normal. It's not that things are going crazy. It is seasonally normal. All right. Now, if we head over to our next chart, let's take a look specifically at the Northwest MLS. And then, of course, let's take a look at just February alone. So let's blow this chart up.
All right. Let's zoom in on this, and what we're looking at is the Northwest MLS, again, residential only. And as you can see, our inventory year over year is down 9.9%. And as you saw from earlier, in the show, this should be in the 12,000 home range. So we're about half, 50%. If we go on the light side of 2019, we're at 59%. Nonetheless, we are just struggling still again for inventory. Sales, however, only down 3.1%. That's, we're only talking about 180 homes, something like that. Not much, a whole lot at all. When we take a look at the pendant year over year, look at that, man. We're just basically net zero. We're just, a couple of homes off. And that's a big deal, because then when we scroll this down and we take a look at the same month year over year, hey, listen, our inventory is actually up for February, which was good. However, when we take a look at pendant sales, they mirrored that. So we saw a significant bump in pendant sales year over year, which is a big deal. Now, the actual number of available homes is still, suffering. But nonetheless, we're again seeing those positive signs.
Okay, hopefully that makes sense. Now, let's compare that to new construction. Remember, earlier we said new construction was still killing it, especially year over year. Let's dial into that chart. So hang on a second, and let's blow this up.
When we take a closer look at new construction, man, it's just amazing how even last year, when we went from basically, 4.5%, 5% up to almost 8%. And again, this year, we're still seeing some rocking numbers. And our solds are up year over year, 5.1% 2.1% higher on pendant. Now, as you can and I both see, you know, the number of solds on new construction versus overall total inventory for residential, again, not condos, or manufactured homes or vacant land, you know, our numbers are doing super well, even though inventory wise, we're a bit lower. Now, when we drop that down and we take a look at the month of February, year over year, we can tell that, you know, we are 4% above on pendant or on solds, but you know what? It's only a few homes. It's not that's not rocket science. There's only like 29 homes here at you know, basically a 0.5%. Again, not killing it year over year, but remember last year we did amazingly well in February also. Our inventory, you know, for the month of February was down 11%, basically just shy of 200 homes. But anyway, nonetheless, we're still doing really well. There's a lot of incentive still being offered, and definitely make sure you're taking a look at new construction options. If you need a free list, let us know. We'll fire them off to you.
Okay, now, next step, foreclosures, REOs, real estate owned, bank owned homes. Let's be super clear about this. There's been a lot of noise, and I do mean a lot of noise about, oh my gosh, foreclosures, they're on the rise. It's amazing. In fact, you know, as you know, I was watching a couple of other channels, you know, some clients said, hey, George, you need to go listen to this. And I'm like, okay, let me go watch it. And I'm watching it, and then I'm going, that is a bunch of horse pucky. You know, they're talking about, you know, foreclosures, you know, doubling and going up. You know, they went from, you know, 150,000 in 2021 to, you know, 358,000 in 2023. And I'm like, yeah, what's your point? And you might be saying, well, George, that is double. Time out. First of all, there was a moratorium on foreclosures from 2020 through 2023. I believe it was March of 2023. We didn't see hardly any change after that, especially in our area. You want to talk about numbers. Hey, look, go back to 2019, which was 638,000. That was considered a great market. Same thing for 2018. I think it was 900,000 in 2017. 13, 14, and 15 all had well over 1 million foreclosures. I mean, those are real numbers. When we talk about what's going on today, look, you know what? They're there to sell you something. Make sure you understand and look at the real message. Okay? Yes, I'll get off my soapbox and let's delve into really what's going in our area, what's going on with foreclosures, and let's just blow up this chart here.
All right. Again, we have our wall of shame, and we went through the foreclosures that are quote unquote active on the market. And some people are like, George, how in the world would you do that? Well, for heaven's sakes, there's only 56 throughout 3/4 of Washington state, for heaven's sakes. So really, we're only about 50% higher year to date than where we were. It's 56 versus 54. Whoop-de-ding-dong. I didn't translate all of the numbers back down here, and it really doesn't much matter because really at the end of the day, our foreclosure inventory is super, super low. When we dial down and we take a look at the numbers here from just February 2023 to February 24, you know, we had a quote unquote 66% increase, if you want to consider it such, and that's only what's active today. I want to say that our actual increase is probably only about 4% like it is up above. Why? Well, because we had so many different homes that, you know, were, well, not a completely accurate that, you know, went off of that chart. So nonetheless, when we take a look at this, even with all of these crazy numbers that do not include real bank-owned homes, okay, look at this. You know, we're dead nut on target, you know. And then down here, you know, it says, hey, you know, pendants are up 52%. Well, you know, which is 12 homes. That's pretty much. And then we're, again, talking 3/4 of Washington state. 3/4. All right. And then the actual number is actually 8 because when we take this number off, That just ended up being 8. But anyway, nonetheless, we left those numbers there. If you have questions, let me know. We do track a lot of foreclosures. We help a lot of credit unions and other lending institutions with them, so we can give you some really sage advice if you need some.
Okay, there it is in the nutshell. Our market is doing really well. Yes, the ugly homes out there, people are starting to look at them again in a different light. Rose-colored glasses, I guess. Anyway, look, the market is doing really well. We're still drawing down inventory. Yes, interest rates are still on the way up. No, we're not going to see a real estate market crash because, well, you actually have to have inventory to do that. And we don't. If we compare it to 2019 pre-pandemic, look, we're at 59%. If we go back further, we start dropping down into the 50s and in the 40 percentile as far as actual homes available. Really, we have only half the inventory we should have this time of year. By the time we hit June, we should have 20,000 homes on the market, and we won't. So just keep that in mind as we're rolling forward. In the meantime, if you have any questions, let me know. It's it's a beautiful morning so far. In the meantime, have a beautiful day. Make sure you smash that subscribe button and look, share the information. Send it to 2 people you don't like to help them out, right? Makes you feel better. And make sure that you send it to a few folks that you do like. In the meantime, have a great day. I'll talk to you later. Take care.